$3.88. That is the gap silver trading at $80.62 on COMEX in New York, and the same ounce changing hands in Shanghai at effectively $84.50. That is a 4.8% premium, and when a gap that size opens between the two largest silver trading venues on the planet, the question is not which price is right, the question is why they have separated at all. My name is John. I spent 15 years working inside currency and commodity markets, and I have watched cross-market arbitrage windows open and close across metals, currencies, and energy. When a premium this size opens between Eastern and Western price discovery on the same physical commodity, it is rarely just noise. Today we are going to look at exactly which one this is honestly, using verified data, and I am giving you both sides. Here is what we are covering today. First, what the Shanghai premium actually is and what it is not, because the way this number is being discussed in some corners of the market is getting ahead of the data. Second, the macro forces on both sides of that gap. Third, how the COMEX registered drain connects to what Shanghai is signaling. And fourth, my one specific call for this week. Before we go further, drop a comment right now. Are you in the US or the UK, and are you currently holding physical metal, a vaulted account, or paper exposure like an ETF? The Shanghai Futures Exchange, the SHIFE, is China's primary commodity futures venue. It operates in renminbi and serves a market with a fundamentally different physical demand profile from the West. When silver trades at a premium in Shanghai relative to COMEX, there are several possible explanations, and intellectual honesty requires us to look at all of them. The first explanation is structural. Chinese silver markets carry local import duties and value-added tax that can legitimately account for a portion of any observed premium. The second explanation is financing and currency related. The cost of accessing silver in China through local credit markets versus international dollar markets creates a basis that is not purely a physical scarcity signal. The third explanation, and this is the one that gets the most attention, is genuine physical demand pressure. If Chinese industrial buyers, solar manufacturers, and private investors are competing for available silver more aggressively than Western futures markets are pricing in, the Shanghai price will reflect that reality before COMEX does. A premium this size, nearly $4 on an $80 metal, is large enough that even after accounting for taxes and financing costs, there is likely a genuine physical demand component left over. Think of it like two petrol stations on opposite sides of the same motorway. That gap does not stay open indefinitely. Now let me give you the macro context holding the two sides of this gap apart. The DXY, the dollar index, is sitting at 99.91 according to the most recent data available. When the dollar is weak, dollar-denominated commodities tend to get a tailwind. At the same time, the 10-year US Treasury yield is sitting at 4.24%. Higher yields mean holding non-yielding assets like silver has an opportunity cost. You are giving up 4% annually to sit in metal instead of treasuries. So what you are looking at is a Western paper market held down by yield-driven opportunity cost, while the Eastern physical market is being pulled up by genuine industrial and investment demand that does not care what the Fed does with rates next quarter. That divergence is the structural engine behind the premium we are looking at. Today, stop. I want to be genuinely straight with you here, because this is where the honest version gets more complicated. The claim that this premium is a smoking gun for artificial suppression of the COMEX price, that is a stronger claim than the data alone supports. What the data supports is a divergence driven by identifiable structural factors that is meaningful and worth paying attention to, but calling it proof of suppression requires a level of certainty about intent and mechanism that I am not going to give you. Here is what connects the Shanghai premium story to the COMEX registered drain we covered last week. If Eastern buyers are consistently willing to pay a premium over COMEX prices, the arbitrage logic is straightforward. Metal that can be moved from COMEX-approved vaults toward Asian demand will be moved. That is not a conspiracy. That is how commodity markets work. It is the same mechanism that moves oil between regions when price differentials get wide enough to cover shipping. The COMEX drain we documented last week and the Shanghai premium we are looking at today are potentially two data points in the same story. Western vaults thinning as physical metal follows the price signal east. The directional logic is coherent and the data is consistent with it. If you know someone trying to connect the dots between what is happening in New York and what is happening in Asia, share this video with them right now. This kind of cross-market analysis takes time to put together. When futures contracts near their delivery window, entities that are short face very specific pressure. If registered inventory is constrained and physical demand from Asia is pulling metal away from COMEX vaults simultaneously, the cost of sourcing metal to make delivery goes up. The CFTC Commitment of Traders report shows commercial traders remain net short, which is structurally normal. What is less normal is when that short position was established at significantly lower price levels than where the market is currently trading. I will not put specific names in this script without primary source confirmation. What I will say is the mechanism is real, the aggregate positioning is documented, and the delivery cycle timing adds a genuine layer of urgency to the setup we are watching this week. For UK viewers specifically, the LBMA monthly data on Silver Vault Holdings in London is worth pulling right now. If LBMA Vault data is showing similar directional outflows to COMEX, that is a third data point in the same directional story. China is the world's largest consumer of silver for industrial applications. Solar panel manufacturing alone in China dominates global solar production capacity, requires silver paste for photovoltaic cells at a scale the Silver Institute has been documenting as a structural demand driver for multiple consecutive years. The U.S. Critical Minerals List designation for silver formally classifies it as strategically important to national security and economic competitiveness. That is a policy signal that the industrial demand story is being taken seriously at the government level. Western paper markets are pricing silver through the lens of Fed policy, dollar strength, and yield differentials. Eastern physical markets are pricing silver through the lens of what it costs to build a solar panel, an EV battery connector, or an AI data center right now. Those are genuinely different lenses, and they will produce genuinely different prices until arbitrage, physical flows, or a catalyst forces them back into alignment. Silver disappears into electronics and panels in gram quantities across millions of applications that makes the deficit hard to see until it becomes impossible to ignore. Let me show you how I am thinking about this week through the 3 lanes framework. Lane 1, the paper market. The DXY at 99.9 and the 10-year yield at 4.24% are creating a genuine ceiling on Western paper silver. Lane 2, the physical market. The Shanghai premium of $3.88 per ounce is the headline physical signal this week. Even after adjusting for taxes and financing differentials, a premium this large on an $80 metal is telling you something real about relative demand intensity between East and West. Lane 3, macro. Dollar soft, yields elevated but not spiking. U.S. Critical Minerals List designation adding policy weight to the industrial demand story, and the LBMA as the third data point to watch for UK viewers. In 15 years watching currency and commodity markets, the times I have seen a sustained East-West premium of this magnitude alongside a simultaneous drain in Western registered inventory, those have historically been setups worth watching closely. Framework, not forecast. You decide. Here is the one thing I am personally watching. This week, the Shanghai-COMEX spread at the end of the March delivery cycle, specifically whether the premium narrows, holds, or widens as COMEX March contracts approach final settlement. If the premium narrows as March delivery concludes, the pressure was cycle-specific and self-correcting. If the premium holds or widens after the delivery cycle clears, the underlying physical demand differential is structural and not just a delivery window artifact. This is my one call for the week. John FX Insider, on record. We'll be back next video to tell you exactly what happened. No edits, no excuses. Here is what needs to happen for the optimistic picture to develop. The Shanghai premium needs to hold or widen after March delivery clears. COMEX registered inventory needs to stay constrained, and the dollar needs to stay soft enough that the yield ceiling does not tighten further. Here is what needs to happen for the cautious picture instead. The Middle East situation de-escalates, removing the geopolitical risk premium supporting metals. Simultaneously, if the CME raises margin requirements, leveraged longs get forced out and silver could move toward $75 before the physical story reasserts itself. Both outcomes are genuinely possible right now. Your job is not to bet everything on one outcome. Your job is to watch which conditions are actually developing and position accordingly. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Always consult a qualified financial professional before making investment decisions. I want to ask you 2 things, and I genuinely want your answers. First, are you seeing the Shanghai premium show up in your local dealer pricing yet, or is the physical premium you are paying still tracking closer to COMEX? Second, do you think the East-West price gap closes because Western paper catches up to Eastern physical, or because Eastern physical demand softens? Drop both answers below. Subscribe because next week we are going directly into how to read the LBMA monthly vault report, what the numbers mean, where to find them, and what movements in London silver stocks have historically preceded in terms of price action. This is Currency Insider. Know the market. Protect your currency.